Welcome back, investors. Artificial intelligence isn't just the future anymore. It's the present, and it's reshaping entire industries right before our eyes. With so many companies claiming to be AI leaders, how do you know where to put your money? In this video, we're cutting through the noise to bring you a deep dive into the 5 most attractive AI stocks on the market right now. For each one, we'll break down their competitive edge, the real challenges they face, and most importantly, we'll give you the lowdown on what the analysts are saying. Is it a buy, hold, or be cautious? Let's start with one of the year's top AI performers, Nebius Group, ticker NBIS. Nebius Group is a B2B-focused technology company that has established itself as a prominent integrated cloud provider and AI infrastructure platform in Europe. Operating primarily under the brand Nebius Cloud, the company offers a comprehensive suite of services, including scalable computing power, data storage, and managed Kubernetes, designed to serve developers, startups, and enterprises. Built on a foundation of proprietary software and hardware stack, its platform is positioned as a strategic alternative to larger US-based hyperscalers, with a strong emphasis on security, compliance, and a developer-friendly environment. Beyond its core cloud offerings, Nebius Group has strategically expanded into the high-growth arena of AI as a service. The company provides a full-cycle platform for AI development, offering access to high-performance GPUs, a managed ML platform for training and deploying models, and a catalog of pre-trained AI solutions. This dual focus on traditional cloud computing and specialized AI services allows Nebius to cater to the increasing demand for sovereign and localized digital infrastructure, particularly from European clients, navigating strict data residency and regulatory requirements. Nebius Group, ticker NBIS, has exploded onto the scene as one of 2025's fastest-rising AI infrastructure stocks. But after a staggering 390% run-up this year, the million-dollar question is, can this rocket ship keep climbing, or is it headed for a correction? Analysts have a clear but cautious answer. They classify it as a speculative buy, a stock with high volatility, but also with what they call structural growth potential. So what's driving this incredible optimism? And what are the very real dangers every investor needs to know? Let's break it down. First, the bull case is powerful. It's built on 5 major pillars. The number one game changer is their landmark partnership with Microsoft, a staggering $17.4 billion multi-year cloud deal. This isn't just a contract, it's a massive vote of confidence that validates Nebius as a legitimate global alternative to giants like Amazon AWS and Google Cloud, locking in recurring revenue all the way to 2030. This deal is fueling explosive revenue growth. In the first half of 2025, revenue grew an incredible 545% year over year, and the company is guiding for an annual run rate approaching $1 billion. To support this, they're planning a massive expansion of their data center capacity, aiming for a 7-fold increase by 2028. And despite the huge price surge, analysts at firms like Simply Wall Street believe the stock is still around 27% undervalued, with a fair value near $156 per share. Goldman Sachs also raised its price target post-deal, reaffirming its buy rating. Crucially, the growth is starting to show in the bottom line. The company turned EBITDA positive in its AI cloud division ahead of schedule, proving its operational model can be profitable. Finally, Nebius holds a powerful first-mover advantage in Europe. As the continent's only large, homegrown AI cloud specialist, it's perfectly positioned to benefit from EU data sovereignty laws and companies seeking compliant AI solutions.
Now, let's pivot to the very significant risks. This is not a stock for the faint of heart. First and foremost, the valuation and volatility are extreme. With a sky-high PE ratio of 133 and a beta of 3.5, this stock is a roller coaster. It's not uncommon to see swings of 14% up one month and 8% down the next. Building all that new capacity is incredibly expensive. Nebius plans to raise roughly $3 billion more for expansion, which could lead to cash burn pressure, dilution from new share offerings, or a pile of debt in 2026. There's also the threat of profit margin compression. As open-source AI models become more common and U.S. competitors offer cheaper GPU leasing, the premium pricing that Nebius enjoys today could come under serious pressure. Sustaining their high gross margins will be a tough battle. And let's not ignore the macro risk. Nebius is often named as one of the poster children of the current AI bubble. If overall market sentiment toward AI sours, this stock could be hit disproportionately hard, even without any bad news of its own. Finally, they are facing giants. They're competing with Nvidia, Amazon, and Google, companies with virtually unlimited war chests and deep-rooted enterprise relationships. Any stumble in execution, hardware procurement, or service reliability could see their hard-won market share erode overnight.
Let's break down the analysts' sentiment as of mid-October 2025. The consensus on Wall Street is overwhelmingly positive. Out of the 9 major firms covering the stock, 7 are telling investors to buy. The consensus rating is a solid buy, bordering on strong buy. The driving force behind this optimism is clear: the company's multi-billion-dollar partnership with Microsoft, which analysts from firms like Goldman Sachs point to as a major inflection point for growth. This bullish outlook is reflected in the numbers, with the average 12-month price target sitting between $136 and $145. That implies a potential upside of 20 to 25% from the current share price. However, it's not a uniform buy signal across the board. The sentiment overview reveals a more nuanced picture. While the majority are bullish, some analysts urge caution. Firms like Weiss Ratings and Seaport Research have issued hold ratings, warning that the stock's valuation may be near bubble levels, especially after its extraordinary rally throughout 2025. This creates a clear divide in strategy. So, what's the final takeaway? Analysts largely describe Nebius Group as a high beta growth stock. For long-term investors who believe in the future of AI cloud infrastructure, the recommendation is to buy or accumulate, betting on the company's strong fundamental momentum. But for the short term, the advice is often to hold, acknowledging the potential for significant volatility and sector-wide corrections. In essence, the prevailing stance is buy, but it comes with a clear warning to fasten your seatbelt for what could be a bumpy ride. AMD, Advanced Micro Devices, is a global semiconductor company primarily known for designing high-performance computing and graphics technologies. Its core business is divided into 2 main segments: the data center group, which includes server CPUs, EPYC processors, and data center GPUs, Instinct, and the client group, which encompasses processors for personal computers, Ryzen, and graphics cards, Radeon. For decades, AMD has been a key competitor to industry giants like Intel in the CPU market and Nvidia in the GPU space. The company's strategy has been successfully built on delivering superior performance and power efficiency, capturing significant market share across both PC and server ecosystems. This established foundation in high-performance computing provides the critical infrastructure for its growth in emerging fields. Recognizing the transformative potential of artificial intelligence, AMD has aggressively positioned AI as its next major growth driver. The company leverages its CPU, GPU, and adaptive computing portfolio, including Xilinx FPGAs, to offer end-to-end AI solutions. Its flagship Instinct MI300 series accelerators are designed specifically for AI training and inference in data centers, directly competing in the lucrative market for AI hardware. Furthermore,
AMD is embedding AI-specific capabilities into its client processors, such as Ryzen AI in laptops, to enable on-device AI processing. By integrating the technology from its strategic acquisition of Xilinx, AMD is creating a comprehensive AI hardware stack, aiming to become a leading provider of the computing power required for the complex workloads of the AI era.
AMD has been one of the standout stories of 2025, riding the massive wave of AI adoption. If you've been following the markets, you've seen its stock nearly double this year, trading around $234 as of October 2025, fueled by massive deals with giants like OpenAI and Oracle. But after such a meteoric rise, the critical question for investors is, what's next? Is AMD still a buy, or is it due for a pause? Today, we're breaking down the powerful opportunities, the very real risks, and what the analysts are saying about this AI chip contender. Let's start with the bull case, and it's a compelling one. AMD's growth is being powered by four key engines. First, blockbuster partnerships. The multi-year deal with OpenAI is a game-changer, involving the deployment of up to 6 gigawatts of AMD's Instinct GPUs. This isn't just a small contract. It could generate tens of billions in revenue by 2027, and even includes a potential 10% equity stake for OpenAI and AMD. Second, we have surging data center demand. AMD's new MI350 and MI400 architectures are designed to deliver a massive 35 times higher AI inference performance, directly challenging Nvidia's dominance. This is reflected in their financials, with data center revenue already growing 27% year over year. Third, diversification. AMD isn't just betting on data centers. It's aggressively entering the AI PC space with its Ryzen AI processors, capturing a new segment of on-device AI processing. And fourth, a rock-solid foundation. The company is executing well, with quarterly revenue growth of over 27% and strong forward guidance for the fiscal year. However, no investment is without its challenges, and for AMD, the risks are significant. The most obvious one is competition. Despite its wins, AMD remains a distant second to Nvidia. Many customers are still in the testing phase with AMD chips, and large-scale deployments may take another product generation to fully materialize. Then there's execution risk. AMD must deliver on its ambitious multi-year GPU roadmap for the MI350 and MI450 without delays. Any stumbles in production or supply chain could severely damage market confidence. Furthermore, after its huge run-up, valuation is a major concern. With a forward PE of around 30, the stock is trading at historically high levels. This makes it vulnerable to short-term consolidation or a correction if the blistering pace of AI orders shows any sign of slowing. Finally, as a global semiconductor company, AMD is always exposed to broader macroeconomic and cyclical headwinds.
As of mid-October 2025, Wall Street remains overwhelmingly bullish on AMD, fueled by its massive surge in AI-related growth and major strategic deals with giants like OpenAI and Oracle Cloud. The analyst consensus is clear. This is a moderate to strong buy, with most institutions viewing AMD as a long-term winner in the AI and data center markets. So let's break down the numbers. Based on ratings from 40 analysts, the overwhelming majority are in the buy camp. The average 12-month price target sits between $233 and $240, which is right around the current stock price, suggesting analysts see it as fairly valued at this level. But the real excitement is in the high-end targets. Firms like Barclays, Bank of America, and Jefferies have a price target of $300, implying a potential upside of over 25%. This optimism is driven by AMD's strong AI GPU roadmap and its recent partnership wins. On the more cautious end, Deutsche Bank has a hold rating with a target around $150, and Goldman Sachs remains neutral, citing the strong competition from Nvidia's software ecosystem. The bottom line from Wall Street is this: AMD is widely considered a buy, not a sell. The rising adoption of its AI GPUs and strong data center growth make it a top-tier long-term play in semiconductors. However, after a massive 94% rally in 2025 alone, many analysts are warning of potential short-term consolidation. The general expectation is that the stock may need to pause and build a new base before making its next move toward that $270 to $300 range.
Palantir Technologies is a prominent American software company that specializes in big data analytics. Founded in 2003, it is best known for developing sophisticated software platforms, primarily Gotham, Foundry, and Apollo, which are designed to help organizations integrate, manage, and analyze massive, disparate datasets. Initially focused on serving the U.S. intelligence and defense communities, Palantir has significantly expanded its client base to include a wide range of commercial enterprises across various sectors such as finance, healthcare, and manufacturing. The core value proposition of its software lies in its ability to create a centralized data operating system, allowing users to make sense of complex information, uncover hidden patterns, and support critical decision-making processes in complex operational environments. Artificial intelligence is not a separate business unit, but the foundational engine of Palantir's entire product suite. The company's platforms leverage machine learning and advanced AI to automate data analysis and generate actionable insights. In recent years, Palantir has heavily invested in and launched its artificial intelligence platform, AIP, which is designed to empower organizations to deploy large language models, LLMs, and other cutting-edge AI technologies safely and effectively within their existing operational frameworks. AIP enables boots-on-the-ground operational use cases, allowing clients to leverage generative AI for tasks like simulating logistics scenarios, optimizing supply chains, and enhancing battlefield strategies, thereby embedding powerful AI capabilities directly into their core decision-making workflows. Trading under the ticker PLTR, this company is a leader in AI-driven data analytics software. It's a stock that has delivered phenomenal returns in 2025, surging between 130 to 145% year-to-date. This explosive growth is fueled by powerful momentum in both its government and, more recently, its commercial business, backed by some major new contracts. But with such a meteoric rise, the big question is, can it continue? Let's break down the opportunities and the risks. On the positive side, Palantir's growth is staggering, especially in its U.S. commercial segment, where revenue shot up over 90% year-over-year, largely thanks to its artificial intelligence platform, or AIP. It continues to secure massive government contracts with agencies like the Army and ICE, providing a steady revenue base. The company is also becoming more profitable, with strong cash flows and expanding margins. Looking ahead, there's significant potential for international commercial growth, and the upcoming earnings report in early November is widely expected to show a 70% jump in earnings, which could be the next major catalyst for the stock. However, these possibilities come with substantial challenges. The most glaring concern is Palantir's valuation. With a forward price-to-sales ratio well over 100, the market is pricing in decades of perfect execution, leaving almost no room for error. If growth slows even slightly, a sharp correction is a real risk. The stock is also notoriously volatile. Remember, it fell over 80% during the 2022 downturn. Broader economic risks like a slowing labor market or shifts in government spending could also impact future contracts. Because of these valuation fears, analyst ratings are mixed, leaning cautious.
When it comes to Palantir Technologies, the analyst community finds itself at a crossroads. The consensus is best described as a cautious optimism. While there is significant confidence in the company's core business and its AI-driven growth potential, this is tempered by major concerns about its sky-high valuation. Because of this split, the most common rating you'll see for Palantir is a hold, with a lean towards buy for those who can stomach the risk. Digging into the numbers, the picture becomes clearer. Out of approximately 20 analysts covering the stock, the majority, about 13, recommend hold. 5 are more bullish with a buy rating, and only 2 recommend sell. This tells us that while very few are urging investors to exit, many are advising against aggressive new purchases at current levels. This caution is reflected in the average price target, which sits between $140 and $145. Importantly, this is actually about 15–20% below recent trading levels, suggesting analysts see limited near-term upside and perhaps even a pullback as likely. So, what's the final verdict? Analysts view Palantir as a quintessential high-risk, high-reward play. They acknowledge its phenomenal strengths: rapid revenue growth, particularly in the U.S. commercial sector, and expanding profit margins. However, the elephant in the room is its valuation, with a price-to-sales ratio well over 100. This means the stock is priced for absolute perfection, and any stumble in its growth story could lead to a sharp correction.
Nvidia. Nvidia Corporation, ticker NVDA, is a world-leading technology company renowned for pioneering the graphics processing unit, GPU. Originally founded to accelerate computer graphics for gaming and professional markets, NVIDIA's powerful parallel processing capabilities laid the foundation for its expansion into new, high-growth fields. The company's business is now structured around 2 primary pillars: its foundational compute and graphics segment, which includes its GeForce GPUs for gamers and workstation graphics for designers, and its data center segment, which has become its largest and most dynamic revenue driver. This strategic evolution has positioned NVIDIA as a key enabler of modern computing. The core of NVIDIA's explosive growth and current market dominance is its central role in the artificial intelligence (AI) revolution. The company's GPUs have become the de facto standard for training and running complex AI models, as their architecture is exceptionally well suited for the massive parallel computations required. NVIDIA has built a comprehensive full-stack AI platform that goes beyond hardware, including its CUDA software platform, specialized AI enterprise software, and a full suite of AI solutions and supercomputing services. From large language models and generative AI to autonomous vehicles and robotics, NVIDIA provides the essential infrastructure that powers AI development and deployment across virtually every industry, solidifying its status as the foundational technology partner for the AI era.
Let's break down the powerful growth drivers and the very real challenges that are shaping its future. NVIDIA's case for growth is built on an incredibly strong foundation. The company holds a dominant market share, with its GPUs being the essential hardware for training and running virtually every major AI model. This isn't slowing down. Demand from cloud giants like Microsoft and Amazon, as well as countless AI startups, continues to fuel explosive revenue growth in its data center segment. Beyond just hardware, NVIDIA is strengthening its ecosystem. Its new Blackwell GPU architecture and expanding AI software suite, like the AI Enterprise Suite, create a powerful competitive moat and open up recurring revenue streams. Add to this robust profitability, strong cash flow, and strategic expansion into new sectors like automotive and robotics, and you have a company with multiple engines for long-term growth. However, this dominant position does not come without significant risks. The competition is intensifying. Companies like AMD are making serious inroads, securing major deals that could eventually erode NVIDIA's market share or put pressure on its pricing power. Furthermore, NVIDIA faces substantial geopolitical headwinds. Export restrictions to key markets like China create uncertainty and threaten a portion of its revenue. On a broader level, physical infrastructure constraints, like the availability of power and cooling for data centers, could actually limit the total addressable market for its chips. Finally, after a period of near 100% growth, a moderation in its growth rate is inevitable. When you combine this expected slowdown with its historically rich valuation, the stock becomes highly sensitive to any negative news or shifts in market sentiment, leading to the kind of volatility we've recently seen. Out of approximately 47 analysts covering the stock, a staggering 38 rate it as a buy or strong buy. For context, only 7 suggest hold, and a mere 2 recommend sell. This bullish sentiment is reflected in the price targets, which cluster between $210 and $220 per share. From recent trading levels around $185 to $190, that represents a potential upside of 15 to 20%. So why are analysts so confident? The bulls point to Nvidia's unmatchable leadership in AI hardware. They highlight its deep partnerships with cloud giants and its rapidly expanding software ecosystem as key reasons it's expected to maintain its lead. Most see it as a core must-own holding for any technology portfolio, protected by a wide competitive moat. However, no investment is without its risks, and analysts are flagging some important cautions. The main concerns revolve around Nvidia's premium valuation, which leaves little room for error. There are also questions about how long this explosive growth can continue as the initial wave of AI adoption matures. Finally, geopolitical risks like export restrictions to key markets like China remain a persistent overhang. In summary, the message from Wall Street is powerful. Nvidia is a buy. The confidence in its AI leadership and future earnings is dominant. However, investors should be prepared for volatility, as any stumbles or shifts in the macro environment could impact a stock trading at such heights. The opportunity is significant, but it's not without its challenges.
Meta. Meta Platforms, ticker META, is a global technology leader renowned for connecting people through its family of social media and communication applications. Its flagship products include Facebook, Instagram, WhatsApp, and Messenger, which collectively serve billions of users worldwide. The company's primary business model is advertising-based, generating the vast majority of its immense revenue by enabling marketers to target users with precision across its ecosystem. Beyond its core apps, Meta is heavily invested in developing future computing platforms, most notably through its Reality Labs division, which is dedicated to building the metaverse, a set of interconnected virtual spaces. A central and accelerating pillar of Meta's strategy is its investment in artificial intelligence, AI. AI is not a separate business unit, but rather the foundational technology that powers its entire operation. It drives the content ranking and recommendation algorithms for Facebook and Instagram feeds, targets advertisements, and identifies harmful content. Furthermore, Meta is a leading force in advanced AI research, openly developing and releasing state-of-the-art large language models like Llama. These models not only enhance its existing products, but also position the company to compete in the generative AI space, creating new tools for creators, businesses, and developers, thereby ensuring its long-term growth and relevance.
When we talk about giants in the AI race, Meta Platforms is a name you simply cannot ignore. Trading under the ticker META on the Nasdaq, the company is positioned for what could be a transformative 2025. But this growth story comes with significant challenges that every investor needs to weigh carefully. So, let's break down the bull case and the bear case for Meta. On the possibility side, the argument is powerful. First, Meta is aggressively embedding AI across its entire family of apps, from Facebook and Instagram to WhatsApp and its rapidly growing app, Threads. This isn't just a side project, it's directly fueling their core business, leading to an impressive 21% year-over-year jump in advertising revenue. This is driven by better ad targeting and enhanced user engagement across its massive base of 3.48 billion daily active users. Second, Meta is putting its money where its mouth is. The company has dramatically increased its 2025 capital expenditure forecast to a staggering $64 to $72 billion. This massive investment is focused squarely on building AI data centers and infrastructure, a clear signal that Meta aims to be a leader in AI, not just social media. This ambition has fueled positive analyst sentiment, with the stock surging over 37% in the past 6 months, and some price targets pointing as high as $1,000. However, this ambitious growth plan is exactly where the challenges begin. The first major headwind is rising costs. That massive capex, combined with continued multi-billion-dollar losses in its Reality Labs division, is putting pressure on free cash flow and operating margins. Profitability is a key concern. Second, Meta is facing significant regulatory and reputational risks. A recent shift in its content moderation policy, moving away from professional fact-checkers, could lead to more misinformation on its platforms. This poses a threat to user trust, advertiser confidence, and could invite even more regulatory scrutiny. Add to this intense competition from both traditional rivals like TikTok and new AI giants like OpenAI, and you have a complex battlefield. While Meta's open-source AI strategy is a long-term bet, it may pose short-term risks against competitors with closed, monetized ecosystems.
The overwhelming view on Wall Street is optimistic. As of late 2025, the consensus rating for Meta leans strongly toward a buy. Out of the roughly 40 analysts covering the company, a significant majority, about 25, recommend either a buy or strong buy. This bullish stance is primarily driven by Meta's successful integration of AI into its massive advertising engine, leading to strong and resilient ad revenue. Analysts are also positive about user growth on newer platforms like Threads, and believe the company's heavy investments in AI infrastructure will secure its future growth. This optimism is reflected in the average price target, which sits between $830 and $850 per share. From current levels, that suggests a potential upside of about 15 to 20%. However, it's not a unanimous vote of confidence. A more cautious group of analysts, around 12 of them, recommend a hold rating. Their concerns are centered on significant headwinds that could create near-term volatility. They point to ongoing regulatory risks in both the US and Europe, the persistent challenges of content moderation, and the sheer scale of the company's capital expenditures, which pressure profitability. So while the general outlook is positive, the key takeaway is this: most analysts see Meta as a strong growth stock with attractive upside, but investors should remain mindful of regulatory and cost-related risks on the horizon.